Okay guys, today we are going to have a look at the PAYG system, or the pay-as-you-go taxation system. It's all about tax, income tax, and how people pay it. Before we look at the PAYG system, I just thought I'd give you a bit of context. So everyone has to pay taxes. I know you've heard of taxes before, but this is how it actually works. So the Australian Taxation Office, or the ATO, collects taxes on behalf of the government to pay for everything. So the government gets its money to pay for education, hospitals, roads, airports, anything to do with the community from people's taxes, okay? And the ATO, or the Australian Taxation Office, collects these taxes on behalf of the government. So, when and how do they collect these taxes? Tax is collected throughout the Australian financial year, individual taxes. So from everyday individuals, it is collected across a financial year. Now, this isn't a calendar year. This isn't January to December. The Australian financial year actually runs from the 1st of July to the 30th of June. So the 2014 financial year started on the 1st of July 2013 and runs to the 30th of June 2014. And everyone in paid employment, from people who work in offices, to CEOs, to teachers, to nurses, to truck drivers, to people working in Woolies, anyone in paid employment pays income tax. When do they pay it? Instead of just getting to the end of the financial year and then the ATO saying, here, you owe this much tax, to make it easier for people, they actually pay it. They have a system called pay-as-you-go. So every single time they get paid, whether it be weekly, fortnightly, or monthly, they get taxed. This is known as the pay-as-you-go system. At the end of the financial year, so this year on the 30th of June, workers will complete an income tax return. It's like a form. This form details all sorts of information, like all the various incomes you've had from employment, from savings plans, any excess income that you've had from other parts of your life, as well as any deductions that you might have made. So say, for example, if you gave money to charity, or there's things such as work-related expenses, things that you needed directly for your employment. So if you had your own business and you drove a truck, you could claim part of that truck as a work-related expense or a deduction. The amount of your income that is taxable is known as your taxable income, okay? And that involves your gross income, what you actually got from all forms of money coming in, subtracted the deductions. So from all the money you got from your job and other forms of investment, subtract your work-related expenses, money given to charity and things like that, anything that's counted as a deduction, gross income, subtract deductions, becomes your taxable income. A few other keywords that you might want to write down, guys, are these two ones: tax withheld and tax payable. The tax that you've paid over the year in the pay-as-you-go system, so every single time you get paid, is known as the tax withheld. At the end of the financial year, when everything's calculated up, the amount that you actually have to pay, or that you're meant to pay, is called your tax payable. Now, a lot of this, I feel like I've probably flooded you with information. A lot of this won't make sense until we have a look at an example. So let's have a look at an example. Here is an example. During the 2011 to 2012 financial year, or from the 1st of July 2011 to the 30th of June 2012, Richard earned $1,050 a week. This is equivalent to $54,600 per annum. That phrase per annum, just in case you guys didn't know, means per year. He earned this from his employees and all other sources of interest he had on his investments. So that was his total gross income. Plus, he also has receipts for $375 for work-related expenses and donations. So a key idea in there is that Richard has kept receipts. So if you want to claim anything as a donation, if it fits into a donation or a deduction category, you must have your receipts from it. So he earns $54,600 per annum, and he has $375 for work-related expenses and donations. My question down here says, calculate his taxable income. So if I was to calculate Richard's taxable income, I simply go 5, 4, 600, which is his gross income, including source of all other investments, everything that he's earned, subtract any deductions, which was $375. So my answer for Richard would be that his taxable income is equivalent to 54225. So I worked that out by grabbing his gross income and subtracting any deductions to get 54225. Okay, then if we need to work out how much tax Richard was meant to pay, we need some kind of table. And the Australian Taxation Office does have a formula for this, okay? And it breaks them up into what they call brackets. So, to calculate Richard's tax payable, we need to use his taxable income. So, as we had, 54225. Now, if we look over here at our table, there's different tax brackets. And if we look to see, okay, Richard he's above the first bracket. He earned over 18,000. He earned over 37,000. And then if we look at the third bracket, it's 37,001 to 80,000. And it says if someone falls within this bracket, like Richard does, they need to pay 3,572 plus 32.5 cents for every dollar over 37,000. So for every dollar over 37,000, they need to pay 32.5 cents. First thing we need to work out, if they have to pay 32.5 cents for every dollar over 30,000, how many dollars over 37,000 did Richard earn for his taxable income? So his taxable income was 54225, and so we'll subtract 37,000 from that. Okay, and if I subtract that amount, I come up with an answer of 17,225. So it meant that Richard earned $17,225 that he needs to be taxed 32.5% of. Okay, cool. Let's see, 17,225. Keep that number in my head, 17,225. Okay, 17,225. Let me write that up there, 17,225. And he has to be charged 32.5 for every dollar. And he was $17,225, so I can simply go 17,225. And now I need to find 32.5% of every dollar. Wait, hold on, a dollar. That's a whole amount, and I need 32.5. Cool, another way I can write that is 0.325, or 32.5 cents for every dollar over. And that's how many dollars over. So if I multiply that by 0.325, I will come up with an answer of $5,598. And I'll keep all my cents for the moment, 125. Okay, so Richard needs to pay $5,598.13 or so, plus $3,572. So what I've worked out here is I've worked out the 32.5% for every dollar he was over 37,000. So now I can simply add to this amount plus 3,572, and it would give me an answer of, I'm going to put it up here. Sorry guys, this is really messy. I'm going to pop it up here, which means that the tax payable he needed to pay was 9,170.1. Now it's 25, so I'll round it up to 2 decimal places of 13. So Richard was meant to pay $9,170.13. Now, another big thing that comes up all the time in tax returns is the Medicare levy. Now, the Medicare levy currently stands as 1.5% of taxable income, and he needs to pay it. How much will Richard's Medicare levy be? So his taxable income, as we worked out in the last question, is 5,425. If we need to work out how much he'll need to pay, we're looking for a percentage here, guys. Okay, so we're looking for a percentage. It's not too tricky. Okay, so we simply grab 54225 and multiply it by 1.5%. Now you can do that two ways. You can multiply it by 1.5 over 100, but I want you guys to get used to being able to write percentages as decimals as well. So another way that you could actually write that is instead by multiplying it by 0.015, and you'll come out with an answer of $813.38. So the Medicare levy, or Richard's contribution to covering Medicare, is $813.38, because that is 1.5% of his taxable income. Okay, so now it says express the total tax as a percentage of Richard's taxable income. So his tax payable, from a few questions ago I worked out as 9170.13. That's how much tax he needed to pay, plus his Medicare levy, which was 81338, means his total tax is 9983.51. So that's the total amount of tax that he needs to pay, 9983.51. Let's write that up there, 9983.51. It's the total amount of tax that he has to pay. So the question says express the total tax as a percentage of Richard's taxable income. Okay, in order to represent that as a percentage of Richard's taxable income, what I need to do is I need to put 9983.51 over 54225 and multiply it by 100%, or 100 over 1. Okay, so if I multiply that number by 100%, my answer comes out as 0.184, or 18.4%. Now, what does that mean? That means that Richard pays to the tax office the equivalent of just under 20% of his taxable income. Okay, just under 20% of Richard's taxable income goes to the Australian government in order to fund projects such as roads, traffic lights, whatever. Okay, so just under 20%, or 18.4%, of Richard's taxable income gets paid to the ATO. Now, during the financial year, Richard's employee, cumulatively across the whole financial year, every pay sent cumulatively or altogether $7,797 to the ATO, or the Australian Tax Office. Has Richard paid too much tax or not enough? Calculate his refund or amount still payable. So we know from the last question the total amount he had payable was 9983.51. That was how much he needed to pay. He said his employee has paid through the PAYG system we'll subtract 7797, which means that mate Ricardo still needs to pay $2,186.51. So when he fills out his financial statement, he will get and sends it off to the ATO at the end of the financial year. Poor old Ricardo will get a message from the ATO: you have outstanding a balance of 2186.51 that you still need to pay. Okay, that's everything that's involved, guys. There is so much there. Okay, hopefully you've written it all down and can work on with some examples.